Now this chart shows the value of the July 1180 by 1160 put spread on the S&P September contract as the price of the S&P goes up or down. The colored dashes represent the value according to the days to expiration. Now as you can see, as the market goes down, the value of the spread increases if days to expiration stays the same. And as the days to expiration decrease, the value of the spread decreases if the market price stays the same. You can see that even if the market goes down in the direction of the put spread, the value of the put spread can decrease with the advantage of time decay, making selling credit spreads profitable for an investor. But what about risk? Although the maximum risk on this position is $4,500 plus commission and fees, as a rule, we would not look to risk anything more than 1.5 times what we collect in premium. So, if we've collected $500, we would look to risk $750. We would look to close out the position if the value reaches $1,250, or 5 points. But we're not limited to selling credit spreads on only one side of the market at one time. By selling credit spreads above and below the market, we are able to take in more premium without increasing risk, if the spreads are the same. So let's say that on July 1st we also sold a 1340 by 1360 call spread on the S&P 500 and collected 1.8 points. Now we've collected a total of 3.8 points on the position, 2 from the put spread, 1.8 from the call spread, which is $950, less the commission and fees. Our risk is still 20 points, whether it be the call spread, difference between 1340 to 1360, or 1180 to 1160 on the put side. So now if the options expire worthless, your return on the initial margin is 27% less commission and fees. Return on risk is 23% in 20 days. This chart shows the time decay of both the July 1180 by 1160 put spread and the July 1340-1360 call spread. Like the previous slide, as days to expiration decrease, the value of the spread decreases if the market price stays the same, and the value of the put spread or the call spread increase as the market gets closer to their respective strike prices. We would look to risk approximately $1,250 on either the put spread or the call spread as a stop loss. How can we adjust our position if it does go against us? In this example, we have sold a call spread above the market and a put spread below the market. Let's say the market rises and triggers our stop loss on the call spread. What we would look to do is we would buy back the call spread at a loss and look to sell a call spread farther away from the market to take an additional premium. The put spread, though, would be profitable, which reduces our risk on the trade. Options on the S&P futures contract expire the third Friday of each month. There are now end-of-month options on the S&P futures contract, which expire the last trading day of each month. Both instruments can be used for this program, allowing the investor to possibly create a monthly or even semi-monthly credit spread program. So how can selling credit spreads on the S&P futures help your portfolio? Selling credit spreads can be used to possibly generate monthly income and help to offset losses in a stock portfolio. Let's take for an example that an investor owns a stock portfolio worth approximately $500,000. We would suggest a $50,000 account using S&P credit spreads to possibly generate monthly income. Under the current market conditions, we look to sell credit spreads with less than 20 days to expiration, 4 to 6% or more away from the market, looking to generate 5% per month. This could possibly reduce losses or add to gains of a portfolio by 0.5% per month. Mercury Capital Management uses fundamental and technical analysis to select entry points and exits on selling and buying back credit spreads on the S&P Futures Index, and determines which strike prices would best to be used. Mercury Capital Management examines economic reports, support and resistance levels, market volume flows, and other indicators on a short, medium, and long-term outlook to determine the best way to manage credit spread positions on the S&P Futures Index. We suggest give us a call and let us answer any questions you may have on how this program might meet your portfolio needs.